From a provenance point of view, let me tell you why I'm here, because sort of I arrived about a year ago into New Zealand, and you wouldn't have heard of Alvarium either. I have a 35-year real estate career so far, probably longer than that, because my father was a sort of soldier in the Second World War out of England and ended up in Malaysia and then stayed there and then did a degree by correspondence with Reading, became a chartered surveyor and opened the first chartered surveyor's office in Singapore, which was Malaya at the time, in 1957. So I grew up with this stuff all around me. He then sold that business, by the way, to a large company that was in Hong Kong and Indonesia and Malaysia and Singapore, which you now know today as CBRE. So yeah, that's the provenance that I bring. From my perspective, I ran large parts of two of the larger agencies in the world. That is Colliers International out of Europe and Asia, and Colliers Jardine as it was then, so I was a Jardine Matheson guy. And then sold it to Cushman & Wakefield, which became one of the larger agencies globally when they merged with DTZ. And I ran their global investment program and was their global head of particularly the residential hotels and the non-institutional side of their real estate interests until 2009, 2010. That was 25 years in agency, moving money around and advising people how not to lose money in real estate. And decided to set up Alvarium at that point. So it was me and a couple of clients to invest our own money. And the point there is particular because I think when you invest your own money, you take a little bit more care. No, that's not true. You try and do better. If this would work, that would be useful. Sorry. All right, here we go. It sort of worked. Today, we look after about 200 families. We're specialists in the family space. It was a deliberate ploy to really go and work with families. During my career at Cushman's and Colliers, I preferred working with the family offices in a sense. There was longevity of capital, it was easier decision-making, not so much computer-driven in a sense, and more about the outcomes. We today look after about $18 billion worth of assets. Our view on life and the reason we set up this business was that we think that intergenerational wealth protection looks more like a 50-50 basis in our world. We split our world in non-banking terms to liquid and illiquid. It came about, again, through the genesis of the company in the many years where I used to sit in front of some of the big global investors and say, this is what you should do with your real estate and so forth. And they say, well, you sort of would say that, wouldn't you? You're an agent. And you go, okay. And then the guy from Goldman would say pretty much exactly the same thing. And they'd say, you're a genius. So I would, at that point, say, right, okay, my next life, I want to manage money. Because I think that people look at you differently when you manage money, particularly, and we can do a lot of real estate investment through that process. So out of the 18 billion, about shade under 9 is liquid. And the balance is in the real estate arena. Real estate and private equity, we believe, are illiquid assets and should be treated as such. To the extent that when you want to invest in real estate, we source, structure, execute, and manage the direct investment of that real estate. If we had a role in life, it's probably to turn $1 into $2 every 3 to 6 years. And make sure you take the $2 at the end of the term. So we're very specific about the way we've done that. And again, that's a function of what we've seen for years and years and 25 years of watching people make a lot of money and hang around too long or have too much gearing. Those are the two ways to lose money in real estate, or pretty much the only two ways if you buy well. You're geared erroneously at the wrong time, and or you try and ride cycles with the inappropriate gearing. We're based out of 10 countries now. We're about 250 people. And as I said, we're about 60-40 illiquid to liquid. The real estate model was predicated. How do you invest money in direct real estate and make money? And not lose money, particularly. And that's the thing. Get up every day and say, how do I not lose someone's money today? The reality is it's people. It's people and ahead of the themes. But we break real estate into about 1,000 different asset classes, right down to the wrong side of the street asset class in a different country, in a different cycle at a different time. That comes from sort of a granular agency career of looking at 1,000 different projects every year and understanding and watching some people. Over the years, we looked and watched in sort of imaginary portfolios how these would play out and how they would work. The things that connected the guys, or that connected the portfolios that really never lost any monies, was the guys who ran them. There were individuals, if you take the really best guys in real estate, who don't lose any money. They understand cycles. They understand that asset classes, and right down to specialist asset classes, operate at different times in different cycles and with different returns, with different functions. But it's the key is the people. So we run something called themes and teams across the portfolio, and I'll explain those to you in more detail. Sorry, I just wanted to apologize. This is not a corporate, well, it is a corporate brochure, but this is not a corporate ad in any way, shape, or form. It's simply that we work with direct families only, in a sense, and therefore this is what we walk them through, and we deal with them. So this is a step-by-step process of what we're doing. The real estate structures, essentially what we do is thematically see what will outperform the market on a forward-looking basis for the next 3 to 6 years. On a forward-looking basis, 3 to 6 years, there would be any number of asset classes that are in performance. So if we do take simple examples, the London residential market in 2010 was a very simple call. GFC had just happened, everything was on its knees, equity was at its most powerful, and there was clear mispricing and arbitrage all over the place. And a high tide would float all boats, so you could probably pick a bad property and go with it anyway. Well, the good news is we picked good properties. The reality is we then bought into developers who lacked money, essentially, at that point, and you ran that cycle. It was a very simple call in 2014, 2015 to actually get out of that cycle, and that's what a lot of people missed. It's the thing about real estate you understand as well, and again, from a bird's eye view, is that even the really good guys will hypnotize themselves that the cycles don't apply to them. The danger period is after about 3 or 4 years when they're doing really, really well. And then they say, no, I can do this. And all the tailwinds and all the headwinds and all of the signs are there, but they will persuade themselves that this time it doesn't apply to them. And this is very different to the sense of long investing. You can, in real estate, we think there's 2 sides of investing. There's 3 to 6 years in terms of turning $1 into 2, or there's the 50 years, in a sense of assets that you hold and continue to hold. So we're in the first bucket. It is key as a manager of managers to take the money. You've worked really hard in the first 3 to 4 to 5 years to make the asset work. You've executed a business plan. The reason we do 3 to 5 years is because it gives us the highest degree of visibility of inputs and effects and effects that external effects on the real estate. If you can see a beginning and a middle and most of the end, you're well ahead of any other investor. If you can find a team to execute that strategy who are granular experts in that strategy, then you are going to do well. The only way you're going to come unstuck is if you stay too long, and therefore a manager should be measured by the actual outcomes, the money in, the money out, as opposed to spot valuations, which are dangerous in this marketplace. We run a hub and spoke structure. We're the hub. We have spokes, which are our joint ventures. When we find a theme like German student accommodation or low-cost housing in Barcelona or offices in Manchester under £20 a square foot within a square mile of a certain piece of infrastructure or travel infrastructure, we will find a best-in-class team to execute the strategy. We will form a joint venture with them, and we will provide them with the capital between 100 and 300 to 500 million, depending on the scale of it. And we will execute that strategy over 3, 4, 5 years, exit. They are self-liquidating strategies for the reasons I just outlined. And I think that's the best way in our space. And we don't mind opening the doors the following day. If somebody can prove that the conditions are good for that, that's absolutely fine, but we will close the doors and take the money and start again. Right. This is a example of the various pieces. There's the residential Hadley Group, there's Queensgate Investments, which is, I'll touch on this, hospitality, Germany, opportunistic, retail shopping centers, and structured real estate finance, which we'll come back to. Much the same, but in a slightly different slide in terms of themes, teams, and execution. This is probably the key slide. What drives earnings and values if you're looking at value add in terms of direct real estate investing? There's a series of effects, whether it's urbanization or demographic trends or long-term capital, infrastructure. Again, all of this leads to a mispricing. There's also a fundamental about real estate, which is a bit of a statement of the obvious, but it is that real estate is a inefficient and an emotional asset class. There are people in real estate who the barriers to entry in real estate are very low, but the numbers are very high. So to that end, there's always a lot of opportunity and mispricing and arbitrage in real estate. One example, we acquired a large site in London last year for about £76 million for the development of about 975,000 square feet of real estate. It belonged to an 82-year-old man. He basically bought it 32 years previously for about £10 million. There was nothing in the cyclicality of our real estate that suggested we should be buying sites with planning permission in London in the middle of Brexit. What was clear was that it was a lazy planning permission. The gentleman concerned was in the money significantly. And to that end, £76 million was a lot of money to an 82-year-old man. He had told his property people to get the planning permission that he could get, and they did, and that's great. So he's in the money, he doesn't mind. His kids definitely want him to sell this thing. Right, so we're on. It is a year, 15 months later. It took us 12 months to get the proper planning permission, which was 2.1 million square feet, with our partner, who is a planning expert. So Themes and Teams, the team is a planning expert who identified the site and brought it to us in the first place. And it took us another 3 months to exchange contracts tomorrow to a Malaysian firm, that we call them without announcing it now, for £152 million. Now, that goes against any cyclicality that we see, but it just identifies all of the nonsense, if you like, of real estate, and the fact that an elderly gentleman who inherited something to inherit something owns a £76 million site in the middle of London, or not in the middle of London, in Zone 3 in London, and has the ability to sell it and cares less. That shouldn't be able to happen in an efficient market. There's 2 million square feet of sales, of a planning permission there, and it should be found, and there should be some sort of body in the equity markets, for instance, that would identify that. Real estate's different. But it needed the planning guys, to bring it to us, because it's a granular piece of dirt. Now, that's one example. There are multiple examples. We have 12 operating platforms in different places that have these people that have the ability, and we spend all of our time seeking out these individuals and the people in sectors. Asset-rich operational companies, another one. Are we private equity real estate, or are we real estate per se? And we try to identify this by saying, look, we would buy a company, an operating company with lots of real estate, but we wouldn't buy an operating company without the real estate. Or we would buy a real estate company without an operating company, but again, we would not buy the operating company without the real estate. So to that end, what are they? Healthcare, education, hotels, service departments, student accommodation, all of those things. We buy the operating business and we house the real estate. There is massive arbitrages in those sectors, simply because private equity guys don't like real estate to a large extent, except Blackstone. They're very good at it. And the real estate guys definitely don't like operating companies. That's a no-no. Now, where the arbitrage probably lies there, if I'm giving examples, is that the private equity guys will refuse to pay and overpay a multiple on an underperforming business, irrespective of the price of the real estate. Let me give you examples again. We bought a serviced office business, one of the best serviced office businesses in London, 5-star serviced office business with properties that it owned 11 of the properties out of the 28. Revenues were 50 million, EBIT was 20. Market price was about 11 times. So that's 220 million. We paid 240 million. There were 51 bidders, including the usual players of Blackstone and BlackRock and Adia and all of these guys. And everyone said, well, it's this young company, these strange people who have overpaid. They've paid 12 times earnings. How can that work? It works for two reasons. It works because the business was owned by Mesro from Morgan Stanley, and they hadn't been in there for 7 years, and it was massively underperforming, and we can turn the business round. But we understand they don't want to pay for that. The main reason it works is because we're buying central London real estate at £1,000 a square foot, and that's nonsense. We could have emptied that business the following day and made money. We could have burned the business entirely and just sold the real estate. How 51 bidders can't see real estate for its intrinsic value outside of a multiple of an operating company, I don't know, but it's just a different way of approaching it. The arbitrages that sit in asset-rich operational companies is significant across the world. But this is the key. It's thematic examples. It can be event-driven. It can be legislatively driven. Our German student accommodation platform came out of a legislative change in Germany that they said we're now enabling the private provision of student accommodation in Germany. We had seen that film before in the US, in the UK, in Spain, in Italy, and on it went. It works. It does work. We have we've spent about $9 billion of real estate. We've had about $4.5 billion of equity out. This is no need. This is just a schedule. We are headlines 31% money in, money out over 8 years on 97 transactions on about $9 billion of equity all in and all out. That system has been tested to within an inch of its life, and it's about the talent. It's about the cycles, but mainly it's about the talent. Some of the talent in real estate and the granular understanding and the working abilities to understand cycles, moving parts, contractual liabilities, and a very important piece in real estate is also debt, I will admit. And there are some people who are much better at debt than others. That's in essence a summary. That need. I wanted to talk as we're in New Zealand, and I'm relatively new here. When we got here, I chaired the company, and I'm in New Zealand because my good wife is a Kiwi, and she had finished her 25-year OE, and it was time for her to come home. So home we came. We set up the Alvarium office here because I chair the global group and I chair the investment committee. So I commute to London, but we set it up here with a couple of the guys, myself and a PA. We have since expanded the organizations here. We spent about $200 million here last year. In essence, quietly, mainly through lending, mainly through debt. And I think if you're looking at arbitrages in New Zealand, I would, because the market is relatively small, the significant arbitrage is clearly in lending at the moment. The banks have disappeared from the scene. I think because they're Australian banks, to a large extent, their books are full for whatever regulatory or financial reasons. And it's the same in the UK. It's the same in various other countries of the world. We're getting equity returns for debt-like structures. And as a real estate people, we're comfortable with the risk because we're also comfortable with the cure. What I would say is that when we started coming to New Zealand and looking at the return profile here, I would say there's a little 200-300 point gap or benefit in New Zealand to a like-for-like basis in European countries outside of probably Germany, where the lending is so cheap. And we then talked to some of the families that invest with us out of America and out of Europe and the Middle East and so forth, and said, there's some cracking investments here, we're doing this, that, and the other, do you want to put money in New Zealand? They went, well, no idea. Didn't think about it, hadn't thought about it, why would I? And we said, well, look at the numbers, and they did. So we have a wonderful group of LPs here and the families here in New Zealand co-investing with us. And by the way, by us, I mean, out of the $4 billion that we have out at the moment, 18% is our shareholders and principals' money. So we do lead. The genesis of this was we want to invest our own money, and people co-invest with us on a pari passu basis. So we have amazing families investing in New Zealand who would never have thought of investing in New Zealand. The point of that comment is people in New Zealand and Australia should and are beginning to invest around the world. The world is your oyster in a sense. There are amazing returns to be gained. I think everybody worries a little, clearly, if I can, everyone can buy a flat in London because they've got a brother or a sister or whatever it is. Investing in a platform in Germany is very different, but worth investigating. Things like in Germany, the last time we borrowed money in Germany against our portfolio, we borrowed it at 82 basis points fixed for 10 years. Now, you don't need to be a crazy mathematician to know that if you're building yields at 7% and borrowing money at 82 basis points, there's a massive carry trade, and it's not difficult to do. I think there should be a broadening of the thinking because the market's quite constrained here in terms of co-investment or thinking about investing in other places in the world as well. It's a rush. It's difficult to explain a global strategy in 20 minutes or 30 minutes and what have you, but we started as two people in a glass box about 9 years ago. Clearly, we've had our theoretical understanding of the sector. We have a target today in terms of the $18 billion to about 40 in the next 2 or 3 years to 50. We have our own balance sheet in terms of the individual, the shareholders that we have. But the system and the market works. We're seeing a lot of reallocation to direct investing. We are direct investors, and there is a way and a means to not lose money and to consistently outperform. We believe in the sector. It isn't easy, and you have to do a lot of R&D into the right people. I had a benefit as being the chair of 2 of the large agencies to identify these people through my day job, but they are very good, and they don't lose money. So the research is find the right people, find the right sectors, and make sure you sell. That's it.
Thank you very much.
You're welcome.
Thank you very much, Andrew, for your time, really good presentation, and giving us some insight on the global perspective. We've got a few questions for you. One of the questions would be, Andrew, you talked about real estate cycle, which often are linked to specific regions.
Yeah.
Which simple economic variables do you use to monitor these trends?
Simple economic variables. Okay, that's not a phrase I know. Variables.
Variables, yeah.
Economic variables.
Sorry.
To monitor the trends. In terms of cyclicality, there's, yeah, I suppose we look at macro and micro, and again, it's not an economic variable, or there's no necessarily economic indicators. Clearly, as we hit 2008, 2009, there was significant economic issues that brought all of the markets down. In terms of the cyclicality of the micro asset classes that we look at, that can be driven not necessarily by economic change or macro or micro improvements or problems in the market. It is, for instance, the German piece was a legislative change. In terms of a measure, I suppose if you looked at 2011, 2012, looked at Europe, and you looked at Spain, you looked at Greece, you looked at Italy, there was cliff edge stuff. We wouldn't necessarily do that. You'd wait, and we waited until clearly the bonds had retreated or the bonds had sort of retreated somewhat in Italy and Spain, and the banks had recovered a little in order for us to then go into Spain. And we did go into Spain. We went into Spain in a big way, 500 million euros in 2013, and we came out last year and we're happy as. I'm sorry if I'm not asking the question, but I think it's an economist's question potentially to me that I maybe am not understanding. But from our perspective, when we look at cycles and R&D, we look at asset classes that we believe are about to run in a 3 to 5 year cycle for macro, political, legislative, demographic, and/or urban change. Those are the things that we look at.
Fantastic. Talking of which, there is another question on this cycle. So, what do you believe are the real estate asset classes poised to outperform over the next 3 or 5 years?
The next 3 to 5 years. Well, I think I've identified a couple or three of them. We love asset-rich opcos. We think that the market is not set up for those, and we have a red line in terms of the absolute ability to enforce in the event of default. That is the legal ability. So really, that points us to New Zealand, Australia, Singapore, Europe, US, and Canada. Not much else. We may break our rules for Vietnam. we're looking very strongly at, but that's because we got Vietnamese and Singaporean partners. Asset-rich opcos, lending, credit. We're a natural equity investor, but we've been pushed right into the debt stack because we're getting senior secured lending in the teens with warrants, with profit shares and stuff, and that's nuts. Why would you be in equity? And if the banks continue to refuse to lend to anything outside a vanilla piece, that is with income only, we will make hay. There's barely any point outside of the highly opportunistic multiple, as in planning plays, investments, to stay as an equity investor when you can lend money at 14 with a 20% profit share. It makes no sense. Yeah.
Very good. So some opportunities in Europe. There is another question when coming back to your example on the German market.
Sure.
If the cost of funding is so cheap, isn't it a free option?
Yes, it is. Yes, I mean essentially that's what we looked at. We looked at we assumed that yields would compress dramatically at this point, but there's a correlation issue between the banks, the banking community, the ECB, and the central banks, and the real estate markets. The imperfections are massive, and I think to us, yeah, if somebody's giving me, and we marked it on the day. We said, look, we'll mark this day. Not only was that money fixed for 10 years, it was portable. We could sell it to somebody else. It's essentially a product trade. But what we did was built a whole 3,000 units of student accommodation, rented them all out, sold it to the GIC at a cap rate under 4%, and made a 4x. That's what you do with cheap money. Or you lock it in for 10 years and you take the carry trade.
But there is no free risk. There is no free lunch.
No, there is no free risk. You're quite right. But you mitigate risk. The detail within all of that, and it might sound easy, is the track record of the developer, the track record. So to that end, we said to the German partners that we found, and they said, please give us 100 million and we'll buy this site. We said, okay, you participate in the tender, you get the bank debt, you get the planning permission, you come and sit in front of us, and we will give you that 100 million. We'll buy this. This is what the joint venture agreement looks like. This is what the structure looks like. I'd known them from my previous life. The guy has one of the largest architectural development companies in Berlin. We know they can execute. And the main problem was they had to fight through the newspapers to get planning permission for people to pay for student accommodation, because the German journalists, if you like, objected to the fact that people should have to pay for student accommodation when it was actually state provided previously. So it was a big fight through the newspapers, but they got it. They did all of they said they did. We did it. There is no free lunch, but there is detail and effort and execution capability. And again, it's back to the people. It's back to finding a team who can execute. The money is relatively straightforward. But the risk mitigation of, is not only is it a 15% IRR that you target, it's a zero loss. It's so literally every day, how do we not lose this money? And the risk mitigation is critical. Multiples are multiples. You get carried. If you protect the floor, the rest will be fine. The rest can be what it is, in a sense.
Thank you.
You're welcome.
I've got another one or two questions. One is more related to investing. So how can investors access international or global real estate opportunities like the one that you mentioned by investing in a fund? You talked about limited partnership, but
sure.
Does it exist in the form of a fund?
Yeah. Everybody's different. I think out of the 12 platforms that we have, and it's not about us, it's about, there are other providers out there. 2 of them keep permanent capital, so there are funds per se. But they keep permanent capital because they're in a space of the asset-rich opcos, for instance, that you really need to have because you're up against Blackstone and Brookfield and these guys. There are 2 REITs. That's easy. You can do that. But that's essentially long-term income in the UK. The UK is set up for long-term income because it has, as a standard, the 25-year FRI lease. So therefore, an intelligent operator in the UK can create significant income out of de minimis risk in the UK on a forward funding basis. So we have 2 REITs that are delivering extraordinary returns because the guys are clever. And we know that because we backed them in the first 20 trades on a trade-by-trade basis before we went out to the REIT. And they're 20-for-0. So again, talent. Can you access, anybody can, it's more about research. It's very difficult for somebody here to go, how do I invest in Germany, and how do I trust that investment in Germany? I don't want to, you can't be pointed in our direction. You have to know somebody, go somewhere, or as an old agent, walk into the Collier's office and say, I want to talk to your Berlin office, and make sure you talk to the CEO, because you want somebody local to shout at if they send you the wrong way. And that's it. But it's not easy, but you can research it. Or find people who've already done the research. And it's not easy because New Zealand and Australia are geographically located where they are. Clearly, there's a lot of cross-border investment of this nature in Europe, and especially from the Middle East, for instance, where there's so much push on their investment to invest elsewhere.
Excellent. Thank you very much,
Well,
Andrew.
Right, cheers.
Well done.